Welcome. Hi, everyone. I think we still have some folks who may join us soon. I just want to say thank you all for spending your Friday morning with the Appcast crew here. Let's do some introductions as people fill in. My name is Andrew Flowers. I'm a labor economist here at Appcast. Really excited to be joined by my Appcast colleagues, Josh Previte and Caitlan Wrona. So Josh and Caitlan, please introduce yourselves in terms of your title and what you do at Appcast.
Awesome. I can go first. I'm an economic data analyst here at Appcast. I've been here since 2020. And my day to day is looking at our industry benchmarks and marketplace trends, really across the marketplace.
Awesome. And I'm Caitlan Wrona. I'm our Senior Director of Strategy over our healthcare vertical. So I actually joined Appcast back in January and spent a little over 5.5 years in the healthcare space, leading a TA recruitment marketing function. So familiar with the space. We are clients of Appcast. So just here as an extension of all of our healthcare clients.
Awesome. Caitlan, it's great to have you both colleagues, new and old. So let's get right to it. We're going to share some slides and walk through some data. I'll kick us off and talk about this morning's March jobs report from the Bureau of Labor Statistics. Josh will be sharing slides, and after I walk through the kind of latest updates of the jobs report, I'll hand it to Josh, who will talk about some trends we see in our own data at Appcast in terms of recruitment marketing. And then we'll wrap up with Caitlan talking in terms of strategy with the healthcare space, some kind of industry specific insights there. So healthcare is going to be a theme throughout all this. So let's just dive in. What was the headline number for this morning's jobs report? On the the figure that came out at 8:30 this morning, it kind of shocked a lot of people. It was 303,000 net new jobs added to the US economy in March. The average forecast, according to Bloomberg this morning, they before the report came out, they published that the consensus average forecast was 180,000 new jobs. And so 74 economists at Bloomberg put in their forecast. And this number that came out, the actual true number, 303,000, exceeded every single one of those 74 forecasts. So this is becoming a pattern where the resilience of the US labor market kind of is surprisingly immune to high interest rates. It's surprisingly immune to sour consumer sentiment. So even if you hear bad vibes about maybe a recession's happening, the U.S. labor market is just chugging along, adding new jobs. So 303,000 net new jobs. That's the blue bar here on the far right side of this chart. But the light blue and orange lines overlaying these columns, these are the 3 and 6 month averages of job gains. And the story here is that I had been telling previous to recent months, I've been telling everyone that, yeah, the job market is cooling. These lines are kind of trending downwards. There's still really strong job growth numbers, right? But actually, this story is starting to change, and it's becoming kind of a re-acceleration. You see how the lines are kind of starting to grow again? So you may have, if you've heard me talk about the economy or heard this, other economists use this term soft landing. I think this is starting to look more like no landing rather than a soft landing. So the idea of a soft landing was cooling in the labor market, but in a gradual way, not like a crash of a recession and a spike in layoffs. But what we have here is more like no landing in that it's kind of taking off again. So again, 303,000 net new jobs in March, exceeding every single Bloomberg forecast expectation. So that's pretty huge. And on the next slide, what we're going to see when we dive beyond just the payroll employment figure, that's the 303. There's a separate figure, which is the unemployment rate figure. That also gets a lot of attention. Good news here too. It ticked down from 3.9 to 3.8%, and that's good. But again, I wouldn't read too much into 1/10 of a percentage point change. It's kind of, a rounding error. The story broadly is that for more than 2 years now, you see on this bottom pane for 28 consecutive months, we've had an unemployment rate at or below 4%. So this is really strong, right? 303,000 new jobs, 3.8% unemployment. Really great headline numbers. But let's dive even deeper and break this down by supply and demand. So first, let's talk about the labor supply side. And on the next chart, the favorite measure you maybe hear me talk about when we measure job seeker activity, it's the prime age labor force participation rate. Like we show this chart on Recruitonomics, on Appcast, pretty much every Appcast brief, we like to track this. And what is it? It's the share of 25 to 54-year-olds, so-called prime age workers, right? Not to be ageist, but this cohort we track over time. So it's apples to apples, and it, isn't distorted by the aging baby boomer generation, right? And what you have here is that it is at or near this kind of pre-COVID peak. So 83.4%, it actually ticked down a tenth of a percentage point from February to March. Again, don't read too much into kind of small changes in the data. It's still high is the story here. We see a lot of participation by job seekers, either to be employed or unemployed, but actively searching for work in the last 4 weeks. That's what this is measuring: the share of people employed or actively searching for work in the last 4 weeks if they're unemployed. So really strong supply figure. You see here the broad story we've talked about a lot. I'm going to mention it later, is that over the last year and a half, 2 years, there's just been this huge surge in supply. That's something I'm going to come back to in terms of the jobs report and some of the anomalies that in recent months people have been pointing out. Wait a second, these numbers don't add up. They're all explained by a key issue, frankly, a polarizing issue in our country. It's immigration. Explains all these discrepancies. So I'll get into that in just a second. But on the next chart, this is kind of our favorite kind of go-to chart. It's a supply and demand chart, right? We look at the demand for workers in the U.S. labor market. That's the dark blue line here. That's total employment plus unfilled job vacancies, right? So that number gets updated each month. That dark blue line, it's kind of been flat, right? Because what's happening is we're having strong job gains, employment and hiring is happening, but job openings are falling, right? So future looking vacancies for hires are going down, but the labor market is still adding jobs at a pretty robust pace. So this number, this demand number, this dark blue line, is kind of moving sideways. What's happening, as you saw with the previous chart, is supply is increasing. That's the light blue line. The labor supply here, the light blue line, that's the U.S. labor force. It's the number of people who have a job, whether part-time, full-time, gig work, or who are actively searching, as I said. And that number, just shy of 168 million. That's the light blue line here. And the story here is this rebalancing is the word, right? Where the orange shaded area where demand exceeds supply, that is narrowing, right? We're seeing rebalancing because the labor market was super tight in these orange areas when demand exceeds supply. That's what we mean when we say it's tight. And then it's slack in these shaded blue areas when supply exceeds demand, when there's just more job seekers than there are jobs. Jobs are scarce. That's the shaded blue areas historically, like during the COVID recession, right? Or even prior to 2017. What we see in the orange areas is this tight labor market where just the demand for workers exceeds them, where it's, it's really workers are scarce in those orange areas. But this kind of imbalance is narrowing, and that's a progress that we want to see. We want to see a normalcy. We want to see a more boring kind of matching of supply and demand. So that's a good chart to kind of keep in mind. And on the next slide, given this kind of broad context, we want to acknowledge that a lot of financial markets, the stock market and traders, they're paying attention to wage growth. Why? They want to see wage growth normalize and come back down to its historical averages of around 3 to 4%. And that's happening. And why are traders and financial market participants so concerned about this? It's because the Federal Reserve, which has hiked interest rates to very high levels, the highest levels in 4 decades, is paying attention to inflation. And one input to inflation, of course, is labor cost. And if wage growth, if this figure had started to reaccelerate and go up, that would be concerning for the Fed. The Fed may think that would feed through to inflation, and that maybe they would have to raise interest rates even further, right? Well, good news, folks, all around. This report is just I asked myself, how strong is too strong, really? Because this report, 303,000 net new jobs, 3.8% unemployment, And now wage growth, it's still historically quite strong at 4%, right? In the 1 month of March, it was growing at around 2.9%. But over the 3 months going in Q1 of this year through March, it was about 3.9%, so a whole percentage point higher. And then over the last year to March, that this dark blue line, the 12-month rate, is a little over 4%. So the story here is wage growth is normalizing at an acceptable level for the Fed, not too hot, but also pretty strong for workers. 4% is actually above the 2.5%, 3% historical average we saw in the 2 decades prior to the pandemic. So this is another piece of good news. So on the next slide, we've kind of covered supply and demand in the labor market. We've covered wage growth. Let's get into the details here before I pass it to Josh and Caitlan to talk about our recruitment marketing benchmarks and Caitlan to go deep on healthcare. Let's just review the key industry job gains. So leading the way, once again, is this broad category of what I like to call standing up jobs. Like if you've ever heard me talk about standing up versus sitting down jobs, the impetus here is to go beyond the old school blue collar versus white collar. When I talk about standing up jobs, I mean, yeah, things like leisure and hospitality. You see it added 49,000 jobs, or construction that added 39,000 jobs. But it's also beyond just these direct care providing jobs or direct production jobs or service jobs. Think of things like educators or healthcare. Again, this is going to be a huge theme of our Appcast brief today. Healthcare adding 72,000 jobs here, or this broad education and health services category adding so many jobs. The story here is these kind of jobs, whether they're in nursing or they're in construction, these standing up jobs continue to grow pretty robustly. More lackluster is the kind of so-called white collar space, but I like to think of it as sitting down jobs, the laptop class jobs. Professional and business services is maybe the best category for this. It added just 7,000 jobs, which is okay. But we're going to get to it in a second. On the next chart, we're going to show you a key category that people have been looking at, which is tech. Tech added 0 jobs, exactly 0 net new jobs. It didn't decline, it didn't increase, but this category that the Bureau of Labor Statistics calls information, it was basically flat. And you saw that over the last year and a half, 2 years, there's been a lot of declines, right? This is the tech session. This is the so-called, white collar recession. That is real. I want to acknowledge that tech is a big part of our kind of culture. It's a big part of our stock market. But honestly, this information category, the tech job market, is 2% of the entire labor market. So these job losses are and were real. The headlines you read about Meta and Google and Amazon laying off tech workers, that was true. But it seems like the worst is behind us and that we're kind of not adding jobs in tech, but we're just kind of not losing them anymore either. And I like to say, again, this is evidence of this dichotomy, this bifurcation between the standing up jobs, the construction, the healthcare that's adding, and then the sitting down laptop class jobs like information or professional and business services that are just kind of flat. So on the next chart, this is the real star of the show. This is healthcare employment growing so strongly. It's I call it the standout industry for job growth here. Adding 72,000 jobs here. You can see that there's really no signs of this acceleration of growth over the last 2 years. There's no signs that it's really slowing down. So that's healthcare. And on the next slide, as we kind of walk through industry by industry and look at the trends, this is another one. Despite the housing market being kind of lackluster, construction continues to add jobs. The standing up employment is pretty robust, right? 39,000 net new jobs. Why is that? We can get into that maybe in the Q&A. Part of it's infrastructure projects from the federal government's policies. Part of it is there's a long pipeline of multifamily residential construction that takes years, bigger projects like apartments. So demand for those construction workers. Even the point being, even when the single family housing market has been cooling and home building is cooled, construction continues to add jobs. So on the next slide, we talked about information being being flat. We talked about healthcare being strong. We talked about construction also being quite strong. Here's another source of strength. And again, a standing up job, leisure and hospitality, in the last 2 months, adding almost 100,000 jobs over the last 2 months. So again, 49,000 in March, very good. The next slide here, as I kind of progress through and kind of, you're going to get the story here. This is the thing I want to kind of start to, as I pass the baton to Josh and Caitlan, this is what I want to call our attention to. The dark blue line here is healthcare job growth. year over year. And you see it's 4.5% growth year over year. And the light blue line here is everything else, literally all non-healthcare job growth in the country. And that's growing at 1.6% year over year. And the story here is that these lines, you see how like historically, like prior to COVID, if you look at these lines, healthcare is less cyclical. That makes sense, right? When there's recessions, you still need nurses, you still need doctors, right? It doesn't go down, right? In 2008 or 2001, healthcare doesn't really go down. If anything, it goes up in some cases. The rest of the economy, the light blue line is cyclical, right? It goes down when there's a recession. COVID was different in the sense that healthcare employment also went down dramatically, like everything went down dramatically and then sharply bounced back up. But something's happened in the US economy post-COVID where there's just structurally a higher demand for physicians and nurses and home health aides and pharmacists and go on down the line. And we can get into what components of healthcare are really driving it, but it's pretty broad based. It's hospitals, it's physicians' offices, it's the one actually weak area within healthcare that hasn't fully recovered its jobs is nursing care facilities. So like that's still a room for growth. And so this demographic outlook of the U.S. with an aging population, just a tremendous amount of demand for workers. So I'm talking too much here. I'm going to pass the baton. So again, the story here is healthcare is growing. Just two more tidbits before I pass it to Josh. Next slide. Unemployment, this is a kind of negative thing I want to call out. Unemployment for African Americans rose in March, something to keep an eye on. I think if you look historically in the shaded area, these numbers, when you look at by race, they kind of are volatile. So just I want to call that out as something to watch going forward. Next slide. One other source of concern in recent months has been that the household survey employment measure, this dark blue line, had been declining. Well, good news is that it finally increased last month. It kind of ticked back up. The light blue line is the payroll number that you heard me talk about, the 303,000. So why is this measure why is this gap emerging? If you go to the next slide, the story here is immigration. We've had just a huge amount of immigration in this country. This Congressional Budget Office revised up their forecast for the number of immigrants last year by 3 million. So that's a huge gap here. And then on the next slide, when we look at who are these immigrants, where do they come from, it's typically, again, not to get political here, but just looking at the data from the Congressional Budget Office, it tends to be through non-legal channels. So like the reason I end on this note, even though this data doesn't come from the jobs report, the reason I end on this is, Josh, if you go back 2 slides, when we looked at the gap between the household measure of employment declining and the payroll measure rising, what was happening here is this is now we make sense of this puzzle, is that when you survey businesses, they were adding jobs. When you surveyed households, they were not adding jobs. Well, which one do you trust? I trust the businesses one. Why? Because particularly non-legal immigrants, undocumented immigrants, were less likely to answer these phone surveys, less likely to acknowledge they had a job. So what's happening is, even though it's polarizing our politics, you can go forward 2 slides, Josh, back to my final slide here. This surge of non-legal immigration has been a big boom for the labor market. It's allowed us to add all these jobs in construction and leisure and hospitality especially, but it's also, of course, polarized our politics, and that I know is not a great note in an election year to end on. But the real story here is the labor market is robust. 303,000 jobs exceeded expectations, and it's largely driven by healthcare. So with that, I want to pass it to Josh.
Awesome. Thank you, Andrew. So in this section, I'm going to talk about how these macroeconomic trends have affected recruitment benchmarks, mostly around cost per application and apply rates. So into my first slide here, we have overall cost per applications for those longer apply processes, those ATS apply processes. We did see cost per application tick up a bit again in March. We're now at $17.01. I believe that's about a 0.7% increase since February levels. It really was only by a few cents, but something that's really interesting to me is if we look at the inflection point there for cost per application at the end of 2023, beginning of 2024, looks very similar to the chart that Andrew was showing at the beginning about the jobs. So we're definitely seeing, those job trends impact cost per application here. But to put this in check, too, if we compare March cost per application in 2024 to previous years, we're still well below those levels. You know, a little over $5 compared to 2023 and more than that compared to 2022. And then a pretty significant impact to these cost per application levels has been apply rates. And again, just to familiarize everyone with apply rates of the job seekers who are clicking on job ads, it's the percentage going on to complete that full application. And so we saw a very significant increase in March, and it's really followed the trends that we've seen since December. And so what this ultimately means is job seekers are less selective. They're applying to a higher percentage of the jobs that they click on. And then if we spend a couple slides here on the easy apply processes or the quick apply processes, we actually saw cost per applications come down slightly. Again, not too significantly from February to March, but we're now sitting at $4.68. And that decrease can be attributed, at least partly, to apply rates. So for those easy apply processes, the apply rates are now at 19.39%, and we've seen a pretty steady increase since the summer of 2023. So this month was a little bit greater increase than some of the previous months. We're now at those, around those July 2023, June 2023 levels. But it's really just been following the trends of previous months. And now if we start to get into specific industry cost per applications, do want to set the benchmark here with the overall increase was 0.75%. But I do want to focus here on what Andrew was talking about earlier, the sitting down versus the standing up jobs, because again, we are seeing some trends here between those. Many of the industries who did see the increase in cost per application from February to March were those standing up jobs. I'm talking construction, I'm talking about manufacturing, food service, all saw pretty significant increases in those costs per application. Obviously, there's going to be some exceptions here. I'm looking at finance. It was an increase. Healthcare down. It was a slight decrease in cost per application. But it's interesting to me to see these cost per applications continue to follow the same trends that Andrew was just talking about with the jobs. And then if we get a little bit more specific into job types, generally did see these specific job types fall into the patterns of their overall industries. A couple I do want to call out right now is the heavy and tractor trailer truck drivers. That's a feature that we had on the last Appcast brief. And we noted last month how these cost per applications for these CDL type truck drivers have been decreasing pretty steadily over the last year. We saw this continued into March, so a 6.68% decrease in that cost per application. And then maintenance and repair workers, that's your maintenance technicians, your repair technicians, a pretty 11% decrease in cost per application despite that construction skilled worker increase. I think it was about 14% on the previous slide. So a little bit of an anomaly there. And then as I start to segue into Caitlin's section, did want to call out a few healthcare specific job types. Most job types here fell into that 3% decrease in cost per application that healthcare overall experienced. I'm talking nursing assistants, RNs, those speech language pathologists, etc. But we had a few job types buoying that number as well. So when I look at dietitians, when I look at LPNs, did see 14% increase in cost per application, which is definitely noticeable. And then the last slide I have for you here is a little bit more focused on those nursing positions. We have seen nursing cost per application come down slightly since 2022 highs. But if we compare this to other industries or just the overall numbers, this decrease in cost per application is much less noticeable. We're still seeing $47 cost per application for these nursing, for the RNs, for the LPNs, which is still one of the most expensive job types out there. And even nursing assistants, those CNA positions you can see are also, remaining pretty flat so far in 2024. So with a little bit more insight on the healthcare market, I will pass it over to Caitlan.
Thanks, Josh. Awesome insights as always. All right, so continuing on the topic of healthcare, let's do a quick recap of the data. So you want to go to the next slide. We'll kick it off. Overall, we have low supply of relatively passive target audience, and even with the increased engagement that we're seeing at the start of 2024, it's probably not going to be enough to meet the demands of the industry per Andrew's chart. So Andrew also touched on this briefly. It's worth reiterating that the challenges of our current landscape are felt across the healthcare ecosystem, regardless of specialty, acuity, or even the staffing model. It's really just how that each organization is impacted that is different. So it varies by geography, hiring volumes, your employer brand, your reputation, et cetera. So while there is this somewhat common experience of hiring in healthcare is hard, how that transpires for one organization is different from the next. But this doesn't mean that organizations are not filling recs. Hires are definitely being made. It just means that to be successful, it takes a little bit more time and intentionality to attract the right talent. So I'll unpack that last statement a little bit if you want to move on to the next slide. So those in the space understand that recruiting talent in healthcare has an added complexity due to the human elements that drive both the demand for staffing, so your patient volumes and preferences, and the supply to meet demand, so candidate volume and preferences. And while we use workforce planning models to try to predict the impact of the latter for TA, time may not always be an option. But to counter that, you can understand your target audience and craft a candidate-centric approach. If you don't understand your candidates, you're essentially recruiting blind, in my opinion. So it seems obvious, but I feel like sometimes as organizations, we lose sight of the fact that we're actually selling the jobs to the candidates, and the candidates are actually consumers. And so what do I mean by that? To really focus on them as consumers, take all of your consumer preferences and apply that to your candidate experience. Consumers have options, opinions, expectations, and they have preferences. As consumers, we prioritize online platforms that are easy to navigate and offer a seamless shopping experience. We not only leverage, but act on product reviews and ratings. I can't tell you how many things were in my cart that I took out because of reviews. Price transparency and the ability to compare options is critical. Customer support communications are instantaneous. Tracking is in real time. The entire process is mobile optimized, and I can go on and on and on. But essentially, if you're not approaching your candidate experience in this lens, recruiting will most likely continue to be a challenge for you, even if the dynamics shift. Because preferences continue to emphasize the need for a more high-touch, instant gratification, technology-enabled recruitment model. But it goes beyond the technology and just kind of the process. How you engage your candidates is equally critical to success. So there tends to be a heavy focus in recruiting on volumes, and I know it's a numbers game, but if you start to focus on quality versus straight quantity, you will not only improve the candidate experience, but see increased operational efficiencies for recruiters and hiring managers, improve throughput metrics, and more efficient allocation of your recruitment efforts across the channels that are actually working. And for those familiar, I'm not specifically talking about the Appcast capital Q quality metric here, but a more general term for being intentional with how and where you show up in the marketplace to connect and build meaningful relationships with candidates. So really take the time to build a data-driven approach to your online presence, including your jobs distribution strategy that allows you to diversify by target audience and optimize to performance. Leverage source data to understand what channels are engaging your more active candidates and what channels are reaching your passive audience, and then customize the content, imagery, CTAs, everything based on the platform, target audience, and goal. And your media mix isn't actually the only way that you can drive quality. Investing in your employer brand and maintaining a consistent brand presence will help or will have a positive impact on conversions long term. Short term, your job descriptions are your number one marketing asset. Take the time to actually work on them. Build in strong messaging that differentiates you and your brand from your competitors. Make sure that it resonates with your audience. and that the content is specific to them, not internal or content or kind of your own personal preference. And that's a big one. So, the performance of your paid campaigns can actually be strengthened or weakened by your organic content. So make sure to make that free content count. And to build on that foundation, treat every lead like gold. So if you have a quality lead, applicant, or candidate that doesn't convert to a hire, don't just let them walk away. The strategies that you use to nurture them vary by the level of engagement. So, for example, how you would nurture a passive candidate lead would be dramatically different from a candidate who may have withdrawn or declined your offer at the last stage of the process. But it's detrimental to assume that you can rely on active net new applies for every single rec you open. Your CRM or ATS, whatever you may be using, a spreadsheet if you have to, whatever database you have to organize, to maintain your passive candidates and those that are not actively part of your organization should be your most utilized resource. And then last but not least, and it's somewhat stating the obvious, healthcare is complex. There isn't a universal approach to recruiting that will satisfy hiring demands, unfortunately. Each market is different. Each organization has unique business needs and problems that they're trying to solve. So yes, there's this kind of universal challenges in terms of our labor pool, but a one-size-fits-all approach won't be successful. So just invest in an agile recruitment marketing strategy and process, customized to your target audience as much as possible, and iterate based on what your data is telling you. Use these benchmarks, but your data is really what's going to drive success for you. So.
Thank you, Caitlan. That was awesome. Time and intentionality, and for that matter, also agility. Caitlan's comment that candidates are consumers. I almost want Appcastians to get that as a tattoo, right? Job candidates are consumers, and we should look at it in that lens. So awesome content, Josh and Caitlan. I know we're a little over time. I apologize for that. That's because I'm over caffeinated and was too excited and had to go on and on about the jobs report. But are there any questions in the chat? I see one from Patrick about resharing the jobs added chart, which I think is maybe the first chart that perhaps Patrick, we can distribute these slides to you if you reach out, or Josh, if you want to go back to that first chart. But any other questions? Because I think we're a little over time. Thank you, Rachel, for your comment. Caitlan and Josh were fantastic. So we're over time, and I just want to say, if you have any questions for those who've joined the call today, like Patrick about the chart, we will gladly answer your questions. Just reach out. I'll actually put my personal email in the chat here. Just reach out to me, Patrick, and we're going to end because we're over time. But thank you again to Josh and Caitlan, to Liz, and so many others at Appcast making this happen behind the scenes. And thank you to all our guests. Thank you for coming.